Hello everyone. This video is going to be focused on the exercise number 2 that I assigned as a homework. So, so this chapter is focused on recording journal entries, posting them into the journal ledger, and then finally preparing a trial balance at the end of the period. So this question is focused on the events that happened for the month of January. So now just for you who have done the question, and it is a good exercise for you to see the walkthrough process, and I already posted the solutions for the students who are in my RLB and RLC section. So what I wanted to do is with this video, I wanted to walk you through the process of journal entry so that if there's any question, you guys can ask me during our live class. And then obviously then I'll go through the journal ledger as well, and then into the trial balance. So whenever you're doing or approaching a question where you're required to record journal entries, it's always good to read the question from the beginning. So this question is a is a focused on a brand new company. So you're presented with the following information and transaction for Canadian fast food for the month of January. You and your friend incorporated a new business. So remember we talked about the type of organization. So in this case, they created a new corporation. So this is a legal entity that was created to start a new business to run a takeout restaurant in downtown Toronto. You rented a retail space and converted the place into as a takeout restaurant. So following transaction took place in the month of January. So this is the first month, and these transactions took place. And what you're required to do is journalize the following economical event and post them into a journal ledger and then prepare a trial balance. So there are three things you're doing: you're recording these transactions and posting them into a journal ledger, then preparing a trial balance. Okay. So first transaction you have there is you and your friend invested 50,000 in a business and issued a common share. So I always recommend at the beginning for you to go through that process that I explained you. First, you identify the accounts that being affected. So in this case is cash and common share. So these are the two accounts that are being affected. Okay. So once you understand that there are two accounts, now the next thing that you wanted to know is what type of account they are. So the cash is an asset account and common share is an equity account. So in this case, you invested money in the business, you and your friend. Okay. So you always look at the impact on the from the prospect of the business. So the cash increased. Okay. And if a cash increased, and that means it's a asset, an asset increased, what do? We debit. Common share is an equity, and we know that equity belongs to a credit rule, and this also increased. So if the equity increased or the common share increased, what do? So we go look back at the rules, and if the equity increased or the common share increased, what do? We credit. So the entry to record this transaction is we're going to debit the cash and credit common share. Then you come into a journal entry, and this is where you post the entry. You put the date first, then you identify the one that account that being debited. So we cash is debited, and we put that on the debit side. Then you list the credit account, which is common share, and you put that on the credit side. And you put it in narration and say issued new common shares. And that's what will get you the marks for the first entry. So all this work is a rough work. So if you're doing this for your group work or your group assignment, or you're doing this for homework, or doing that for the midterm or exam, you always do this rough work at the end. Once you find out which account need to be debited and credited, then you come into a journal, and then list the account, debit account first. And if there's more than one debit account, you list all the debit account first. Then you list all the credit accounts. Then we have a second entry. Second entry, you paid a contractor 28,000 for renovation. Okay, and you're not very familiar with the type of accounts or the name of the account, so I gave you a hint here uh, that we can use an asset account, which is leasehold improvements, for this contractor expenses. So we paid $28,000 for a renovation. So when we pay a renovation, so it's an asset because we're building a, something which can be used for future purposes. So in this case, we will be using as a leasehold expenses, as a leasehold improvement, as an account, which will be considered as an asset account. Okay. So first we say, okay, the first account we have is a leasehold improvement. And what's the second account that being affected? You see the word paid. So whenever you see a word paid, it means it's a cash. Okay. So the cash is the second account. Leasehold improvement is an asset. It is increasing. If the asset increase, what do? We debit. Cash is also an asset, but in this case we paid, so it decreases. So if the asset decreases, we credit. Then we come here, record a journal entry, we put the date, debit the leasehold improvement, and credit the cash for 28,000. And that was your second entry. January 12, you ordered the office furniture from a top notch furniture for $12,000. The furniture was delivered on the same day, and you agreed to pay in 15 days. Okay. So in this case, you bought a furniture. Okay, you order a furniture, and you got the delivery at the same day as well. Okay, so technically you have a furniture in your business. You bought a furniture. Okay, and did you pay? No, you did not pay. You agreed to pay in 15 days. So from there, your first thing you're gonna do is identify the accounts. So first account that I can easily identify is furniture, because that's what came in the business. And the second account, what could it be? We didn't pay, so it's not cash. We're supposed to pay, it's a liability. So what account are we going to use? So whenever you get something on credit, we use accounts payable. Okay, so now we're going to go through the process. The furniture account is an asset, and this account increased. So if the asset increased, what do? We debit. Accounts payable is a liability account. Okay, what happened with this account? Is your liability going up? Yes, it's going up. And what's the rule? If liability increase, what do? We credit. So the entry becomes debit the furniture account, credit your accounts payable. Okay, and that's your journal entry. Next entry we have, you ordered and received the produce, meat, and a beverage from Gordon Food Services, and you paid $3,500. I put the wrong amount here. Okay, so you paid $3,500. So now what are we going to do with that? So we going to go through a process. So we bought something that we're going to use in a business. So usually what happened is some companies, they will use inventory account, and some company will use as a cost of food or a purchase account to record these expenses. Okay, so in this case we're going to use cost of food as an expense account. So we use cost of food, which is an expense account, and we said we paid, that means it's a cash account. Okay, so cash decrease, that means if asset decrease, it's a credit. Cost of goods, cost of food is an expense, and if expense increase, what do? Debit. So our journal entry will be debit cost of sales, then credit cash account. The next one we had is we paid, you made a sale of 5,600 for the first week and received all the money in cash. All the store sales will be recorded as a walk-in revenue. So in this case, this is a walk-in revenue. So what are we going to do? So cash is the account because we receive the cash. It increases, and if it increases, what do? Debit. What's the other account we have is walk-in revenue. And walk-in revenue is a revenue account, and the rule for that is revenue increases, and if revenue increases, what do? We credit. So journal entry will be debit cash account, because we always put the debit account first, credit walk-in revenue 5,600. You made a sale of 3,200 for the first week of corporate clients, and they agree to pay in 15 days. So this is a credit sales. We did not receive the money. Okay. So if we did not receive the money, what account do we use? It's an account receivable account, and the customer owes you the money, so therefore it's an asset. Account receivable increase. Account receivable is an asset. If asset increase, what do? We debit. What's the other account? It's a revenue account, and we are naming it as a catering revenue. And revenue increases, so what we do? Credit. So the entry will be debit account receivable 3,200 and credit a catering revenue for 3,200. Okay. Next one, January 25th, you paid $8,000 to Top Notch Furniture for a furniture purchase on January 12th. So now in this transaction, we are paying for the furniture that was purchased on January 12th. So we're not buying anything new. We're simply paying off the liability. So we see that we paid, so definitely cash. And cash increase or decrease? It decrease. So if it decrease, asset decrease, it's a credit. What's the other account that's being affected? It's a accounts payable. Okay. So accounts payable is going up or down. The liability is decreasing. Okay, we're paying off the liability. So if we pay off the liability, what happened? The liability goes down. If the liability goes down, what do? We debit. So now the entry become debit accounts payable and credit cash for 8,000. And I have January 28th. Now this is something that you have to keep in mind, and is good for you to practice as well. So sometimes what happened is you could have more than 2 accounts. There's minimum 2 accounts when you're recording journal entries. And now there will be a situation where you can have more than 2 accounts. So in this transaction, you have to be very careful in reading the transaction. You paid insurance for 2,400 for 1 year, from January to December. So technically, you're paying for 1 year, but January is already done. So technically, you use the services for their insurance for the month of January. Okay, so you're paying insurance in advance, but not for the 12 months. You're paying it for 12 months, but the one of that month is already used, and the other 11 month is prepaid insurance because you're paying in advance. So in this case, there will be 3 accounts that are being affected. So whenever I'm recording a transaction, I'll try to go with the easy account first. Because I say paid, so I know it's my cash decrease, and if cash decrease, I know it's a credit, and it's with credit of 2,400. That's what I paid. Now what am I paying for? I'm paying for insurance, and there are 2 accounts because there is insurance expense, which is for 1 month, and there is a prepaid insurance, which is for 11 months. Okay, now why we are splitting that into 2? Because remember, the accounting rule is anything you have used is an expense, but if you pay for an expense in advance, that's a prepaid expenses. So in this case, we're paying the insurance for 12 months, but one of that month is already used because we are sitting on January 28th, which is the end of the month. Okay, so then we say, okay, how much is insurance? It's 2,400 divided by 12, because it's for 1 year, which is 12 months, is 200 per month. And 1 month is already used, so therefore insurance expense is 200. And 11 month is still yet to use, so 200 times 11 is 2,200. Insurance expense increase, so it's a debit. Prepaid insurance is an asset, it's also increase, it's a debit. So in this case, we have two accounts being debited, insurance expenses and prepaid insurance. So now what you have to do is when you come into a journal entry, you have to list all the debit account first. So it doesn't matter whether you put the insurance expense first or prepaid insurance first, it doesn't matter. So what matters is that all the debit accounts has to be listed first. So I put insurance expense, debit 200, prepaid insurance, debit 2200, and then which account are we crediting? We're crediting cash, okay, which is 2400. So it doesn't matter how many accounts we use, the bottom line is that the debit should equals to your credit. So in this case, if we add all the debits, which is 2400, and we look at the credit is also 2400. So that means that your entry most likely will be correct. So that's your cross check as well when you finish with the transaction, that one side is equal to the other side. So that's how you will record the prepaid insurance entry. Next one, January 31st, you paid a salary of 1800 and cash decrease, it's a credit, and it's a rent expense, and expense increase is a debit. So the entry will be debit, salary expenses, credit, cash. Next one, this is salary expense, not the rent expense. Okay, so next one we have is we paid a rent. Now this was the one we cash decreased, credit, and the other account is a rent expense, and that's also increase, expense increase is a debit. So the entry will be debit, rent expense, credit, cash. The next transaction we have is January 31st, received $1,200 from a corporate customer for a credit sale made in the week of January 24th. So you remember we recorded this transaction where we actually did some sales with some corporate clients and they agreed to pay in 15 days. So some of them paid on January 31st. So we received $1,200 from these clients. Okay. So in this case, we received the cash. So we know that the cash increase, which is debit cash. Now, what are we receiving it for? This is not a new sale. This amount was outstanding to our customer. So whenever customer pays for any outstanding invoice, we use the account receivable. And now the account receivable decreases because the client paid you. So the account receivable is an asset. And if asset decreases, what do? We credit. So your entry will become debit, cash account, credit, account receivable. This is right here. Next transaction we have is you made a sale of 3,200 for the second week and received all the money in cash. So again, we receive cash, cash increase, debit cash. Now, what is the other account? What are you receiving the money for? For the sales that you did. So that is your walk-in revenue. And walk-in revenue increase and revenue increase is a credit. So a journal entry will be you list the debit account first, debit cash account, and credit walk-in revenue for 3,200. Okay, so that's how you will complete all the transaction. So once you complete these transaction, you're done with journal entries. Okay, so you ended up recording all these transactions in a journal. So list it right there. Okay. So the other thing that I didn't have in this transaction, which is what if there was a transaction that took place, but that need not to be recorded. Okay. For example, you actually had signed a contract with, for example, PwC. You signed a contract to provide a catering on a weekly basis, and that will be for $500 for every evening, even that they will be hosting. Okay. So you sign an agreement. Okay, but that has no monetary value. Okay, so in that case, if that even happens, when you come into a journal entry, there is no entry for that. Okay, but if it happens in a quiz or test or your exam, what I want you to do is at least put a date and put a comment here saying no entry. Okay, or say you can say that no economical event, right? So it kind of gives me a hint that yes, you did recognize that transaction, and find out that there is an event that happened, but there is no economical transaction took place, so therefore it doesn't need to be recorded for accounting purposes. Okay, so I want you to make sure that you identify that to me, because there will be a part marks, there will be marks allocated for those things. Okay, so this will complete the transactions. Okay, so if you are doing these transactions, every transaction is independent from each other, and there's marks for every transaction. So if you mess up or recorded one of the entry incorrectly, that is fine, but there's still marks that you get, which are part marks for recording the transactions. So if you identify one account right and the second account is wrong, you still get a part mark for that entry as well. Okay, so always try your best to identify the accounts properly and allocate it and record the transaction in the format that you see it right here. Okay, so then we move into the next step, and I'm not going to go through a detail of that. I'm just going to show you for first two transactions, and then I will show you the trial balance after. So when you finish your entries, you're done with looking at all the rules, and then all we're doing now in general ledger is we taking the transaction and putting them in the appropriate account on the appropriate sites, and then calculate the balances. Okay, so let's look at the first two transactions, and then you guys can look at the solutions after that and then compare your answers, and then if there's anything wrong, you can identify it and correct it by yourself. So first transaction we have is cash account and common shares. So cash being debited 50,000. So we come right here, we identify or find the cash account if you have any. So the cash account is here. There's no opening balances. This is a brand new company, you should have zero balances. You have January 1st, 50,000 being debited. Then you calculate the balance. There was zero balance before, and we bought 50,000. So therefore, we have 50,000 balance in a debit side. The other side we have is a common share. So common share is right here. January 1st, we credited 50,000. And now the new balance we have is 50,000, and the balance is credit because this is on the credit side. Then we just highlight the transaction so you make sure that you actually move this into general ledger. The next transaction we have is debit leasehold improvements and credit cash. So we go find the leasehold improvements. If we don't have any, we just name a new account, leasehold improvements, zero beginning balance, and January 10 we debit 28,000. And then we find out the new balance for this account is 28,000 because there was zero balance to start with, and the new balance is 28,000 because it's on debit side, so it's a debit balance. The second account that being affected is a cash account. So we put the date and put the amount on the credit side. Okay, now we have 50,000 debit balance, and now the transaction has on the credit side. So whenever it's on opposite side, you subtract it. So we're going to subtract 50,000 minus 28,000. Your new balance is 22,000. And what is that? It's a debit balance. Okay, because the debit side was bigger. Okay, so that's how you will keep calculating the balances. Okay, so that's how you will record these transactions. Okay, and you will do that, use the same process to record all the transactions up until January 31st. Okay, and you keep adding or subtracting depending on where the balance is. Okay, and here you can quickly look at the solution. After you post everything, you will see cash going up and down, and that is your new balances, and you end up with the ending balance of 15,800. Account receivable, you record these transactions, you will end up with the ending balance of 2,000. Leasehold, there's only one transaction, so 28,000. Furniture, your balance is 12,000. So this account is not being used, so we'll just skip that. Accounts payable, you will end up with 4,000. You're going to skip this account. Common share, there was no transaction, there was only one transaction. Your balance is 15,000. Retained earning, I kept this account, but because there is no opening balance, there is no balance in the retained earning. Cost of sale, we have 3,000 debit. Walk-in revenue, we have 8,800. Catering revenue, we have 3,200. There is one account that we need to change because this one is 3,500. So that will change to 3,500 because remember I made a mistake here that this is supposed to be 3,500. So if I'm changing this one here, I have to make sure I change that in right here as well. Okay, so that's now changed to 1850 and is 15,300 your ending balance. Okay, so you finish up with all the accounts. That's your account for cost of sale, revenue, insurance expense, prepaid insurance, salary expense, rent, expenses, and that's all. Okay, so you can check these answers, and if there's any question, you can always bring it to the class. And I think this is a pretty straightforward process. All we're doing is just adding and subtracting the numbers and calculating these balances. This is credit balance, that's debit balance. Okay, once you finish that, then we start preparing a trial balance. So when you prepare a trial balance, you start with the company name, then you put a title, then you put a date when you're preparing this trial balance. The next we list the accounts. So as I mentioned to you guys in the previous lecture, you always have to put the accounts in the order. Your asset accounts first, then is your liability accounts, then is your equity account, then is your revenue account, then is the expenses account. Okay, and now when you list the asset, you may want to list all the current assets, then current liability, then non-current, and then for the liabilities you put current liabilities and long-term liabilities, and the equity you put the common shares and retained earning, and then if there's dividend, the next one will be dividend, then you put revenue and expenses. So now this is also a process. So what you do is you go through a journal ledger, find out each balance. So here cash 15,300, put that on the debit side. Account receivable, your balance is 2,000, you put it on the debit side. Prepaid insurance, don't miss that because that was at the bottom. Right here is 2,200 debit. Okay, 2,200 debit. And leasehold improvement 28,000 because we're done with the current assets, so we move into the long-term assets or non-current assets. Then we have furniture 12,000, so make sure that that's 12,000. Accounts payable 4,000. Now we're moving into the current liabilities, and we only have one current liability, 50,000 for common share. So you just take this 50,000 into common share. So you're going from here into a trial balance. Since I've done this before, so I already have the balance. So all you have to do is just name them and put the balance on the correct side. Retained earning, zero balance. Then you go into the revenue. Walk-in revenue is 8,800. You put walk-in revenue 8,800. Then you go next revenue account we have is catering revenue, and that's 3,200 credit side. Then we have cost of sale, okay, which is 3,500. So we're going to correct that because that was something that I corrected after. So we change this to 3,500. Next one we have is insurance expense 200, which is right here. Then we have salary expense 1,800, salary expense 1,800, list them right there. and then rent expense 1000, and that goes right here. Okay, so most likely we list all the accounts now. We'll double check. Okay, so we're done. And then what we do finally, we put a sign here total. We total the debit, which is 66,000, and then we total the credit, which is also 66,000. So now once they agree, most likely they did it correctly, all the postings were done correctly, and then you can move on to the next question after that. Okay, so I hope that this video you'll find this helpful, but again, don't rely on me to walk you through these steps. These steps has to be done by yourself for recording the journal entries. Okay, so that's hopefully this solution will help you out. And then if there's any question you guys have in regards to the second practice or third practice exercise that I posted, the solution is posted for that as well. So if you have any question on that, you're most welcome to bring that to the class next week, and then we'll take that up. Okay, take care everyone, and good luck for your weekly assignment. Bye bye.